Like, you'll just do a regular conversation about what happened with your bank today, or maybe just give like a whole overview.
Yeah. Okay. So, anyways, we're recording right now, but I want to cut this down, so we're going to start in three, two, one.
Hello.
Okay. Hey, yeah. So today is August 11th, and I've got a bit of an update, anecdotal evidence, but nonetheless an update from the banking sector. And Josh, I know you and I talk a lot about this, and so I kind of wanted to share it with you and anyone else who cares about this. So, just in case anyone doesn't know, I'm in the Gulf Coast area, Texas, and which means Houston. And the one of our primary banks that
You
we
sure
deal
not
with,
Dallas?
I'm sorry, where? Never heard of it. Some small unimportant cow town in North Texas. Oh no, oh no, no, no. That's it. We're done with this stream. Go away. Ah, nothing against the poor people in Dallas or whatever, right? Anything's better than the Austinites. Anyways, the takeaway though is this: there are two banks we do a fair amount of business with here in the region. Both of them are somewhat local to Texas, or excuse me, one of them is exclusively local to Texas. The other one is pretty heavily in Texas, I think Louisiana, maybe a little bit in Alabama. But the key is they're regional banks. So they're big enough to do some of the stuff the big guys can do, but they are by no means the mega GSIB or the globally systemically important banks. And today I had to deal with some loan modifications for just regular business in terms of the real estate operations I work on in my real life. And in the closing, I asked the loan officers who I've gotten to know just what was the bank seeing from their perspective. So, were they seeing customers requesting loans? Was the bank's credit committee looking for business? The business they saw, were they pleased with it? Were they issuing loans, etc.? And the impact of that on macro is that if banks are issuing loans, the currency supply in the real economy is growing with actual real money versus fake. If banks are issuing loans, the money supply is expanding. Let's just leave it at that.
Yeah.
And
So basically, I so money is created in that transaction. If when Justin is taking out a loan to buy a property, that money's created because the bank does not. People often think that you have money in your account and then the bank lends that money out to multiple different sources. That may have been true in the past, but not anymore. Now, Justin, the bank just puts, say, $1 million in Justin's account. There's they're not holding that anywhere. It's just a creation out of thin air.
the two ways I like to sell this home, and Josh, let me know what you think about this. The first thing I think is people think the bank has a shoebox with their name on it. They have a shoebox for Josh, a shoebox for Justin, or whoever. Not necessarily the case. There's no shoebox in that regard. The second thing is this: when the bank issues money, imagine in your mind $100 bill, but $100 bill with the Chase logo, or the Bank of America logo, or your credit union logo, whatever. The point is, when the note is issued, when you actually sign your name on the note, like I agree to pay for whatever, that allows the bank to issue their own version of dollars. From our perspective, that is the retail customer or the business, we don't detect the difference. To us, a dollar is a dollar is a dollar. But in this case, there's actually a very different kind of dollar because these dollars are brand new dollars. Again, imagine a $100 bill with the bank logo on it. Or if you want another visual analogy, imagine that there is a huge ass jar of Skittles. And some Skittles are red, some Skittles are green, some Skittles are blue, whatever. A blue Skittle might be the proceeds of debt that a bank issues, that they're just dumping it into the jar. And there might be, for example, for every one red Skittle, say like real money that the bank has, there might be 100 blue Skittles, Skittles issued from debt. Our perspective is we're colorblind. We can understand that there might be different colors of Skittles, but again, a Skittle is a Skittle is a Skittle. We don't necessarily care beyond the fact how many Skittles do we have in our account. So the again, returning to the impact to macro on this is if banks are willing to make loans, that suggests that there will be more money in the real economy chasing more real goods and services. If businesses want to expand or whatnot, that'll drive interest there. But anyways, this was what I heard. Last year, around March or so, the bank had virtually no appetite to loan. They weren't even seeing interest from customers at the same time, too. So it was interesting. They saw a major drop off in applications from customers, and the applications they did get in. This is circa March, April, May-ish of 2020. Credit committee was like, no thanks. We're good. We are just not interested. Then PPP happened, and when the PPP program rolled out, whoosh, an uptick. We've talked about this before. You guys have seen the graphs if you've watched any other real macro channel. It's been discussed before. And there was a second round of PPP earlier this year. Banks started to
So,
jump.
so for people that don't know, what is a PPP loan?
What was it? Payroll protection program. Essentially, what it was is it allowed a bank to issue a loan which got money into the real economy by putting into the checking account of a business. But in return, the bank was able to dump that loan off the balance sheet via the Small Business Association, or excuse me, the Small Business Administration, the SBA.
It's backed by the Fed.
It's backed by the Fed, but this is the key thing. Remember that graphic? Oh, I should have queued it up. But uh, banks only have so much capacity to lend based upon these ratios that they need to maintain. And so for their owner's, or I call it owner's equity, but let's think it was pristine collateral that a bank sits on, they can only leverage that up so much. And so from the bank's perspective, every note that they loan or every note that they create takes up balance sheet space. And so if the government comes along and says, listen, bank, we are more than willing, we as long as you check these boxes, we guarantee that we will buy this note from you. The bank says, listen, we have no problem issuing this note. We're going to take a cut for issuing the note, or I would assume they take a cut for issuing the note, and we're going to pass it on because the government will buy it from us. And hey, listen, if there's no risk to us, we look like we're part of the good guys. We help our customers. Like everyone's happy, everyone's winning. But the key thing, no risk for the banks because the banks could dump it off the balance sheet. And just
that's the only reason why they were lending was because they had risk-free loans that they could create.
Yeah, I wouldn't say.
Well, in March 2020, there was no loans being made. But once the government and Fed said, all right, we'll back these, then the bank said, all right, we'll lend. And
yeah, the vibe that I got from the banks at the time, and again, like there's these two regional banks that we do quite a amount of business with, is that they're not necessarily opposed to lending. It's just that they're being much more cautious, just as customers were being much more cautious at the same time. So everything had frozen, both from the customer side as well as from the banking side. And I will also note that one of the things you see in the real estate world, we've talked about this briefly, but and not to go too much into it here, the fact that Fannie and Freddie can so when we do our multifamily loans, when you if someone were to buy a home in the single family space with a conventional mortgage, it's the same thing applies. The bank itself or the loan broker or whatever can essentially flip it back to Fannie or Freddie, and Fannie and Freddie essentially flip it back to the open market through issuing these bonds. These are the mortgage-backed securities, what Gammon likes to call mortgage-backed sausages, or the sausage concept right there. And the Fed's buying this debt anyways, who cares? But either way, the key is that the origination banks don't necessarily have to worry about taking up precious space on their balance sheet, because they know that there's a guaranteed buyer, the government, essentially, on the other end to hoover this stuff up. Anyways, returning back to these two regional banks. They saw an uptick from the second round of PPP earlier this year, so they did that. They're now going through the forgiveness phase. And it sounded to me, because I was pretty poignant in my question saying, like, listen, are you guys kind of like, seeking out loans? Are you like hurting? I'm not asking if you're hurting for business, but that's kind of where I was getting at. And the response was, listen, that's this bank saying, we have an appetite to lend for customers that we know, customers who want to start projects. Absolutely. Absolutely. Now, it's not saying the bank's going to start writing blank checks, but the bank was, I would say, moderately hot to trot. That's the vibe that I got. Like, oh my god, we need to make a loan. But listen, yeah, we're kind of feeling good. We bring us deals. We'll take a look at it.
With just real estate, or were they loaned to a business?
They were loaned to a business.
It's way different than a business.
Yeah, so like real estate's always kind of its own, because you have Fannie and Freddie sitting behind the scenes, real estate's always been this really bizarre world for lending. And I would actually take it a step further and say real estate's been one of the backdoor conduits of how the Fed's been able to pump money into the real economy. Because if you use debt that's issued by a bank that's ultimately bought by the Fed, case in point, we did a refi transaction for the multifamily, maybe about a year or so, thereabouts a year or so ago. And we paid off our old debt, took out more debt to do so, and we also, I think, cashed out. I can't remember how much we cashed out. I feel like I should know that number. I don't know, $500,000 is what we did on that front. So essentially, we restructured the debt. We're paying less than we were, and the ownership group now has more cash, to play with. Or then that cash was just created in terms of that. And I think the big reason is that our lender who originates the notes or the paper that we use ultimately just gets flipped back to Freddie, and then Freddie goes on and takes it. So anyways, Josh, I see this is very enticing to you, keeping attention focused here.
No, but I'm listening, and like you were just kind of explaining, and like what it kind of brings my mind to is if the reason why I think there's probably no demand for loans would be because of stimulus and incentives that I think that the government is putting entrepreneurs. What incentive does an entrepreneur have to take out a loan and start a business in America right now? I mean, you have to be a diverse, um, like it just does not seem like the environment where an entrepreneur would want to strive.
Okay, fair enough. I see where you're coming from, but I would say in the bigger picture of things, you have different. There's a hierarchy of entrepreneur. When you're first starting your own side hustle, like maybe you're in your late teens or whatnot, just looking to get started, there a stimmy check or whatnot, that's I don't say that's real money because of course it's real money
It
across the
is.
board. But my point is that the impact of let's say like a $2,000 stimulus would be far. Or someone in their late teens getting $2,000 would be someone like a George Gammon getting $2,000. Did you see, like, there'll be a different level of impact. And I think what
Hmm.
you find is once you do the entrepreneurial thing enough, the money is nice. And I mean, it's, of course you want to keep it because that's how you keep score. But it's more so about I've done something. There's on the balance sheet of the soul, there's another receivable that you get, which is like this satisfaction component. It's like you've done it's like being able to sleep well at night. You have, so we're gonna have to like cut that part out.
No, I don't even care. Like
Yeah,
screw
Josh,
it.
trust me. Yeah, it's not
Uh,
so yeah, there's gonna be some trimming on this.
Dustin, I mean, this is strictly for comical purposes. There we
Very
go.
well.
Yeah, I slept extraordinarily well. But Justin, coming back to like, why do you? So did you ask them why they saw a lack of demand for loans?
Right. So we touched on that briefly. The sense that I got was the bank itself didn't quite know what to expect. Customers didn't quite know what to expect. And I think when you're banking at this level right here, you have professionalism on both sides of the equation. And so my gut feeling is that if I needed to really ram something through, I could probably do it as long as I could convince the bank. Or here's what I have. If the bank said no originally, I could get a follow up saying, okay, listen, bank, I know you said no originally. Here are the concerns that I think you have. Let me tell you why these concerns can be ameliorated in whatever business plan I've got, and let's move forward with it. So the answer is there might have been an initial no, but at the level when you have like the partnership going on, you can generally figure out a way to yes if a way to yes actually exists. Do you see what I'm trying? It's not just
Is are yields adjustable? Like, since you have bought a lot of properties, do you get a lower yield than say a first time home buyer, or is it the same across the board?
for a single family home going with conventional paper, you would not get a lower yield in that regard because for the single family paper, and it might have changed since then, but this is how I recall, they're very you have to fit inside the box and they give you no deviation. My late grandmother, she had issue. I mean, she had plenty of money in the bank, but for her to qualify for a traditional mortgage was actually quite tricky because back this was prior to 2008. You could just, to bluntly put it, lie on your mortgage application and go through. But since 2008, they changed it. They really tightened it up. That is the provable income, meaning that you had to, it was based upon your tax return. And for real estate guys, that can be tricky because real estate guys were pros
Yeah,
at
yeah.
keeping it down.
No,
So the point
not
is,
no.
yeah, you could point to the bank saying, we've got like all this money, there's, 8 figures floating around or whatever, but the bank didn't care. I mean, it's not the bank didn't care. The bank's like, listen, we see where you're coming from, but like, we have to keep the note in this box. If we don't keep the note in the box, we can't bounce it off the balance sheet because Fannie and Freddie won't automatically buy the note back. So in your particular case, you would see a difference between owner occupied and non-owner occupied for the single family world. If you buy the home with debt and you actually live in the home, you'll get a better rate than just being an investor. Like we were maybe like a half a point, maybe a full point is what I recall.
Okay.
And for the multifamily space, you wouldn't necessarily get a better rate in that regard, but it definitely helps to not be or to not have it be your first time because because that way, everyone already knows. I mean, it's a small world. Everyone knows each other anyways. But my point is
Hmm.
that if the bank already has a relationship with you, if Freddie or Fannie already have a relationship with you, it goes much smoother. It's like, oh,
Yeah,
yeah, we
yeah.
know what's
The
going on in the
counterparty.
property.
It's so much easier to trust someone after they're already trustworthy.
Yeah, and like it's not so much even trust. I mean, trusting is a big part of it, but it's like, listen, these people, they're battle tested. They've operated. I mean, in
Yeah,
our
yeah.
case, yeah, I mean, we at the property we got, we actually got an award from our property management company for like having the most hard luck for like the first project ever because like we had a flood, we had to do this major rehab. We're right behind a strip club too, so we had to kick out a bunch of a bunch of working girls when we first took over. Yeah, it's just kick out the drug dealers. Just go down. Oh, just go on the list of
Whoa,
things.
whoa, whoa, whoa.
It's business, but yeah, when they on another channel, I can tell you all the horror stories that we've had to deal with. But the point is, we got through it. We got through it.
Yeah.
And so, from underwriting's perspective, both from the originator as well as Freddie and Fannie's perspective, it's like, listen, these guys, they know their shit. They went through some hard times, but they were able to, either raise cash and they need to raise cash. They were able to make it work. And simply put, yeah, they're trusted. We have no problem doing deals with them in the future because clearly they've been able to do fine so far. Anyways, but to answer your question about yields, though, the bank did say this. They said it's very hard for us to compete on real estate deals with the exception of construction loans. So let's say you're building something, brand new or whatnot. That would be one of the bank's bread and butter. So, and the reason that's the case is that Freddie and Fannie, as I understand it, I might be wrong on this because I've never really directly asked the question, but it's the vibe I've always gotten. They love stabilized deals. They're not looking for a fixer-upper. They want the thing that's already ready to rock and roll, that's generating the income. They don't want any bullshit. And so what will happen is that you have these construction guys who build apartments, but don't necessarily operate apartments. They start with, so they'll go to a regional bank or some bank they have a relationship with, get a note maybe at, let's say 3.5, maybe 4% or whatnot. Recourse, meaning that if the project blows up, they're personally liable for it. And they use it to build the property, get the property operational, and it maybe has, call it like a 5-year balloon, but they're not going to be in for that long. But once the property gets stabilized, then the real estate guys who built it will turn around and either flip it to someone like us, because we really are operators, not necessarily builders, or at least not yet. Or what they do is they go back and we do the financing saying, okay, listen, Freddie and Fannie, we've got a Class A property. It's brand new. It's 95% plus occupied. It's throwing off a ton of cash or whatnot. We want you to write us, a note. We want a 30-year AM. We want the first 3 years or the first 5 years, whatever, to be interest only, so no principal whatsoever. We want as low as an interest rate as you'll give us, maybe let's say 2.5%, and then we'll take a balloon at 20 years if we must, and they can get those terms. But no bank can match that, or no bank can match that because no one can. Ain't nobody got a bigger BSD than the Fed when it comes to the world of finance, and that's what's going on. But there is a role to bring this all back to where we were at. There is a role to provide the bridge financing, in this case from construction to stabilization. And there might be another role for, let's say, you want to take over a property, do a rehab on it, but it's not quite ready for Freddie or Fannie, but you think that you can make it ready for Freddie or Fannie. What you might do in that case is you might get Freddie and Fannie on board saying, listen, guys, I want you to pre-underwrite this. Don't necessarily give us an approval, but just keep it on your radar. You then go to your local bank or your bank of relationship with, listen, write us a short-term, 2-year note or whatnot. We're going to stabilize this, and we're going to cash out and close your note by flipping it off to Freddie and Fannie. Here's our contacts there. So you kind of bring the two lenders in sync, and so that way you use, the bank, the short-term note to stabilize, fix up, and that makes the property applicable to run to the Freddie and Fannie thing, which is your long-term financing. So
okay, all right. And so let's just sum it up with what was going down with your bank today.
Oh, so this is what I found was interesting. The bank definitely had, at least they stated, they had an appetite to lend. They were looking for deals. I don't necessarily think they were actively yet ready to solicit for deals, but you could definitely. I'm sorry?
Solicit?
Oh, solicit, like going out and actually like cold calling, customers.
Okay.
But like if you, the way I would say it is, they're not going to go down the, the phone or whatever, start, dialing people or whatever. But they might say, okay, well, listen, if you run into a customer, hey, listen, Justin, are you guys thinking about doing any projects or anything like that? If you are, don't forget we're looking to lend or whatnot. So they might do like a passive solicitation, but I don't think they're actually ready to do active solicitation. Point is, this particular bank was moderately hot to trot when it came to lending. And if they're not the only bank, at least in the Texas area or the Gulf Coast area, looking to do that, that seems to suggest that it's relatively bullish because there will be more funding for projects, construction. I mean, from my perspective, that's real estate.
Mm-hmm.
But, if somebody wants to start, a widget factory or Business. There we go. So that's that.
All right. Sounds good.
Josh, until next time. So take care. Okay.